I am joined by Jens Nordvig, founder and CEO of ExAnte Data, as well as MarketReader. Jens, welcome to Forward Guidance.
Thank you very much.
It's my pleasure, Jens. I can't believe it's taken this long for us to do it. So, Jens, people not familiar with your background, former managing director at Goldman Sachs, former head of research, Nomura and Bridgewater. Tell us about your process. You're something of a quantitative, have a PhD. I think of you as someone who looks a lot at capital flows, where the money is going. Is that fair to say? Is that what your process is kind of like?
So when we launched ExAnte Data in 2016, there was a huge amount of focus on capital flight from China. They had like a balance of payments mini crisis, or it felt like maybe more than a mini crisis when it was happening. So tracking that capital flows was perhaps the most important thing. And we developed a very good model for essentially having a real-time feel for Chinese currency intervention. So that was an example of capital flows being very important. And we have like a very elaborate infrastructure that tries to capture literally all the big flows in the world. An example from the last couple of months would be we've had the regional banking crisis, right, in the U.S. So exactly what's happening with all the capital flows associated with banks have been super important, right? So we have daily data on what is coming out of deposits, what's coming into money market funds, and we look at that closely every day, right? But that's data that nobody would have cared about last year. So it changes all the time what data is the most important.
Right. Just to get into banks, I mean, where is the money going? I know the total amount of deposits is going down. Some of that is because of quantitative tightening. How much of it is actual deposits leaving the small banks that actually need the money, as opposed to large banks who are letting the deposits leave because they want to retain profitability?
Yeah, you have to be very careful when you analyze this data. We've seen this in social media, right? Like right after the Silicon Valley Bank shock, it was very popular to analyze the weekly Fed data, right? And people looked at the loans, and the loans looked like for a week or two like they were collapsing, but that data was distorted by there's some institutions that have been reallocated the data, right? So you have to be very careful.
Right. So you are careful about that. What are you seeing? I guess let's start with loans. Yeah.
Yeah. So let's give you the conclusions, right? So what we've seen is that we came from a period where loan growth in the U.S. was very robust. And it was actually interesting that the loan growth was driven to a significant degree by the smaller banks. Like it was not JP Morgan and Bank of America and Citi and so forth that was really lending aggressively. It was actually the regional banks that were picking up a decent amount of this new lending. And that was the case certainly up until Q3. And then in Q4, things started to change. So what we're seeing this year is that we've had a slowing tendency, right? And then we're analyzing, obviously, what is happening around the Silicon Valley Bank shock. And the ironic situation up until this point is that it's not particularly clear that there's a drop-off in the lending yet. So in a way, that's not particularly unusual. Like if you go back and analyze big shocks like the 2008 shock or even the March 2020 COVID shock, it is often the case that initially in a shock to the system, you actually have bank borrowers that draw on their credit lines. And for precautionary reasons, or because they really need the cash, they draw on those lines, right? And that can actually boost the lending in the short term. So I don't think that effect would have been as dramatic in this shock as it would have been in the COVID shock, where like businesses were really running out of cash and they had to draw on those lines. But there certainly could have been some of it. So I think in the next month or so, we'll get the real verdict as to, okay, we're beyond that, people drawing on their lines. Is there actually going to be a slowing? And it'll be very strange if there's not a slowing, given the pressure that is on the regional banks, right? And in terms of our estimates, the sort of credit impulse that people like to call, like the change in credit extension, it could be in the region 1% of GDP. And then you can think about, okay, how much of a drag on the real economy is that going to be? Probably multiply as a little bit less than one. But you can certainly get, under reasonable assumptions, a big drag on the economy, right? So the Fed is in a tricky spot because they can't see these effects. These effects are hard to model. We don't have many examples in history where it happens, right? If you go back and look at bank deposits, it's not so often that they go down. Like bank deposits normally go up. It's a matter of whether they go up a little bit or go up more, right? But outright going down is highly unusual. But it'll be strange if we don't have weakening lending growth. And I think the problem for the Fed is that they have to make decisions now, right? And the data is only going to start to be clear in the next 1 to 2 months. So from that perspective, I think it would make a heck of a lot of sense for the Fed to be on hold until they have more of that information and to see how this shock is really transpiring. And because of the effects I've described, they just don't have any clean data yet.
So Jens, when Fed Chair Powell gave the press conference in the middle of March after Silicon Valley Bank fell, and then in May, he said something to the effect of, we expect lending conditions to deteriorate, lending to go down. You saw that in the Federal Reserve Beige Book, normally a very boring document that many districts around the country said that many regional banks expected to curtail their lending. What do you think is going to happen? Because I mean, Fed Chair Jerry Powell, he wouldn't raise concern without there being a reason, right? If rather there being a reasonable reason to say, hey, yeah, lending's going to come down pretty sharply.
No, but so we did a conference call with a specialist in regional banks, like somebody who follows the regional banks day and night and speak to the CFOs and the CEOs of those companies, right? To again triangulate the data, right? We have our macro data that we look at, but it's nice to also get some micro data point to see another angle. Like all the regional banks have a goal of slowing their credit growth. Like it's not something that's happening just by accident because their deposits are vulnerable and so forth. It's something they want to do. They want to be cautious about the environment. So really what we're looking at is a situation where we can pencil or write down a scenario where the regional banks are able to achieve their lending objectives that are already cautious. But we have to recognize that there's probably downside risks to that because are they all going to be able to make the loans that they really want to? They all want to make loans into certain safe sectors now and not into the other sectors, right? So at the aggregate level, they can't all make the same loans. So there's probably going to be downside there. So I think we're going to have significant slowing of regional bank credit in the next couple of months. We have not seen it in the data yet. I didn't expect it to be visible quickly in the data because of the drawing on lines that we've talked about. And then a very important question is, are there other credit providers that can fill any gap? Like lots of talk about whether Blackstone and Apollo and so forth, those types of players can really come in and take a lot of business from the banks. And there's probably going to be some of those players that will be aggressive and going to expand their loan book. But don't forget, they lend at totally different terms, right? So a loan from Apollo or Blackstone might be 12%, whereas we've been used to getting loans from regional banks like 7%, right? So it's going to be a different type of credit. We can also think about, okay, is JP Morgan or the big banks going to really step in and fill the gap, right? But it doesn't feel like they have any great appetite to be aggressive on lending. So I think the gaps that are going to be appearing are not going to be so easy to fill. And that's going to have an impact on the economy, right? So I'm just going to say a scenario, right? If the drag from less lending from regional banks is in the region of, say, half a percent of GDP, doesn't sound like such a big number. But what amount of monetary tightening is equivalent to 0.5% of GDP? It's certainly more than 1 or 2 hikes, right? So if we're going to summarize where we are, what the central case is with the Fed, right? So it seems extremely prudent for them to be on hold for a little bit. When they received information before the Silicon Valley Bank shock about where the economy was, that was generally going in a kind of hawkish direction, right? Inflation surprised on the upside. Labor market was very strong, right? So before the Silicon Valley Bank shock, there was a plan to raise the dots, right? They were planning to raise the dot. They abandoned that plan because it was not appropriate given the new shock they were facing, right? So in a way, you have a situation where they were planning to kind of raise the dots, lift them, right? They abandoned that, but we don't know how big the shock is. Could be that there's now an argument to actually lower the dots, right? But it's going to be very hard for the Fed to, we're going to lower the dots because our forecast for the regional banks is such and such, because they have very little specific data where they can see it yet. That's going to only feed into their forecast once they have more specifics. And yeah, I think next 1 to 2 months is going to be crucial. And also just because there's lags in the process, like there's a lot of the loans that have been extended in the last couple of weeks that were probably debated, like before the Silicon Valley Bank shock. So there's some lags associated with that too.
Right. So when you say dots, you're talking about the dot plot, which is part of the Federal Reserve's SEP, Summary of Economic Projections, which they release every other FOMC meeting. Interesting you say that non-banks can fill the gap if their bank lending falls, because banks create money from thin air. There's a money multiplier effect, whereas if Apollo or another sort of shadow bank makes loans, they're making those loans with money that actually exists. They're not sort of creating it from nothing. Is that kind of is a loan from a shadow bank less of a boost to the economy than a loan from a bank?
Yeah, so you can think about it from a money supply angle, and you get a conclusion like you're implying, right? But you can think about it from an interest rate angle as well, right? Like the loan that is provided at 7% is going to be a bit different from the loan that is provided at 15%. And
Yes.
the quantity of those loans is not going to be the same either, right? They think about a borrower that has to pay 15%. They're clearly going to borrow as little as they can, right? So it's going to be a different environment. And the notion that we can just fill the gap from these regional banks that have provided a very significant part of the U.S. Bank credit and overall credit economy with other players, that seems to be a bit heroic to me.
Right. So you said you think it's likely that the Federal Reserve is done. Right now, the rates are at 5.25% on the high end. What do you think the odds are that they stay that high? And also say, the market's now pricing a 16% chance of another hike in June, but they're also pricing in a rapid series of cuts, so much so that they're projecting 25 or 50 or 75 basis points until the end of the year. Do you think that those cuts that are priced in make sense given the macro environment?
The Fed has kind of three dimensions of analysis that it has to go through. It has the traditional economic dimension, right? Growth, inflation, that stuff. That's the kind of stuff that was pushing them in the direction of getting incrementally more hawkish before the Silicon Valley Bank shock. So if it was just that, clearly more than 5.25 would be on the table, right? But there are other dimensions in play now. So the second dimension is a credit dimension, which is the one we talked about a fair bit already, right? So the regional banks are highly likely to lend less than they otherwise would have been. That drag, maybe 1% of GDP in terms of missing credit, could have a significant impact on the economy. Not from 1 week to the other. It's not like a sudden stop, but it's going to be over time start to add up. Especially if there's pressure on other parts of credit as well, rates going up everywhere. So that's the credit dimension. That's the one they referred to really since the March meeting, right, where Powell said we're almost done, right? The third dimension have to do with more kind of acute financial instability, right? So we have a weird situation where we have tension in the banking system, and even last week we had the rescue of First Republic, right, or whatever you want to call it. People like to use different words, but let's just call it rescue.
Yeah, the bankers like to call it a rescue. The media like to call it a collapse or a failure. And I'm in the latter camp, just to be clear.
Yeah. So the takeover, bailout, bail-in, depends on who you talk about. If you're a bondholder in First Republic, it was a bail-in, right? You lost all your money pretty much. So it really depends on where in your capital structure you are. But after that, right, it looked like, now things are going to look better. And then the next 3 days, the regional bank index was down 15% or something like that. And we had a couple of the smaller regional banks like PacWest, Western Alliance, and so forth that look very shaky just from a stock market perspective. And what is weird about this is that normally when you have banking tensions, it immediately becomes a macro issue, right? And here it is impacting the short rate pricing, right? Because it feels like a very serious issue. But on the other hand, then you look at the big banks, right? And the big banks look very stable. Like even in terms of how they trade in the equity market, really not that volatile. We can also see that like JP Morgan's earnings like surprised everybody from actually looked like they benefited from the tension in Q1 almost.
And deposits went up. The money was flowing into,
Yeah, like exactly. So we have a weird situation, right, with severe tensions around specific banks. But if we sort of look at, okay, financial conditions overall, really not moving that much. Like the equity market is not having a bad year, right? Even credit spreads relatively stable. You have to kind of dig in. If you dig into the different credit indices, even like bank credit indices overall are also not terrible, but that's because like the big banks have a huge weight in those indices. If you go down and look at, okay, what does some of the bigger regional banks, MTB and so forth, have to pay? They have to pay up to get bond funding now, right? So there is some stress there. So it used to trade like IG, now it trades like high yield, and like bank debt is not really supposed to trade like high yield.
Normally, if it does, you have a problem.
Yeah, exactly. So it's a weird kind of intermediate type of tension we have, where it's unclear if the Fed should really respond to that third dimension, like the acute financial instability, because it's like a very centered instability around these specific institutions. So I think one thing that we're looking at very closely is, okay, if we literally look at all the different regional banks, like what part of that spectrum is impacted? So we have 3 of the big ones that are out already, right?
Silicon Valley Bank, Signature Bank, First Republic.
Correct, right. So those were banks that were, 2 of them had in the region 200 billion in assets, right? Not small banks. And we have another 6, 7 banks in the U.S. that have assets of that size. That if you sort of say, okay, 3 plus 6 times 200, that we're talking about a lot of bank assets that are really in play here. So that's what we're watching. If there's a couple of small institutions that need to be helped out in some form, rescued, bailed in, bailed out, that's a little bit different. But if it's that whole group of regional banks that are really impacted, then it can get more serious.
Right. So we got a sort of weird cocktail in the cross-asset world where bonds have rallied, bond spreads have not blown out. You said credit spreads have not blown out. What people have to be paid in order to take credit risk on top of the Treasury spread. Equities have performed really well. Stock market has rip-roared, even while we're having all those bank issues. How do you explain that, Jens, as someone who looks a lot at the flows? Why have we had this huge rip-roaring stock market rally while the banks go through so much turmoil?
Yeah, I would go even beyond what you're saying. Like the one asset globally that typically is hypersensitive to this type of tension is like emerging market assets. Like emerging markets really can't handle when there's like tension in a major market banking system. We saw that in 2008. We saw that in 2011 in Europe, right? And then you look at how EM has performed. Like EM has performed very well. So China is a bit of a special story, right? Because the reopening momentum is kind of like petering out a bit. But if you look at EM broadly, EM is traded very well. We have some EM currencies that are at the highs, a bunch of them actually. So everything is a bit unusual here. So that's kind of what makes it fun. The explanation, I think, is relatively simple. And a lot of the linkages, a lot of the cross-asset linkages run through the big money center, systemically important banks. So if those banks are not impacted, and we talked about JP Morgan already, if those banks are not impacted, if they can continue to operate and provide leverage as they used to, then there's a lot of the contagion effects that do not come into play. That, I think, has been absolutely crucial. We can talk about that in the context of the euro as well, right? So I have this thing where I know literally where the euro traded every day. So we can go back to March 15 is when the Credit Suisse bad news came out, right? And the euro started to trade down, right? So what you wanted to think about there was, okay, are we going to have tension in the banking system to a degree where we might get a dollar shortage like we had in 2008 that took the dollar higher, even though it was kind of a homegrown problem in the US, right? And the clear conclusion to that is that we've not had any dollar shortage. We've not had any signs of stress in global dollar provision. And that's the reason why the euro has moved from 106 to 110. So really, if we think about this, it's an unusual period of tension that has not had this sort of typical systemic element to it, even though it comes from the banks. And that explains a lot of the assets you're talking about, US equities, emerging market assets, where the euro is. So that's key to everything here.
Right. So Jens, what sort of you're taught in Macro 101 in school is that currencies trade off of interest rate differentials. So if the Federal Reserve raises a ton and the rest of the world's central banks don't, the dollar will appreciate. Likewise, if the Fed pivots or cuts rates and the rest of the world doesn't do anything, the dollar will weaken. But as you know, in the real world over the past 20 years, typically when the Fed pivots or cuts rates, typically that's something when there's the world is going through a financial period of stress, such as 2008, March 2020. So actually, sometimes the dollar rallies extremely hard alongside the interest rate differentials going the way of the non-US dollar currencies. But this time it's kind of going the way that I learned in school, right? Of the Fed's about to pivot. It's probably done its last hike. It could be one more. Who knows? And so the people are not being rewarded to go into dollar assets as much because forward dollar interest rates are lower. So other emerging markets currencies happen. So it's sort of it's textbook, even though the textbook doesn't normally happen, right?
Yeah. So I think so certainly hard to analyze markets with one variable, right? So that's why the Fed variable doesn't work alone. The second variable is not going to give you all the conclusion, but the second variable I'm going to mention now helps a lot. If you have a global growth variable in your framework for the dollar, it's going to give you very significantly improved understanding of those periods in which the dollar diverged from the signal from interest rates, right? And that could be both in the periods in which interest rates go down when the dollar does well, such as 2019, or it could be the mirror image of that in some periods. So that's something that's been important this year, right? We've had two sources of global growth surprises. We've had the reopening process in China that did support growth for a period of time. We can discuss where it is now, but certainly early in the year it was extremely bullish. We can see it in the capital flows as well. Growth in Europe has also generally been revised up because the energy crisis element has been pushed in the background as energy prices have come down. So those have been very important to dollar dynamics. And then the systemic tension that, even though it was banking tension, it was not systemic banking tension yet. And that has been important as well.
Right. But didn't economic data surprise to the upside in the US as well?
So when we crunch the numbers, we will generally reach the conclusion that in relation to dollar dynamics, it's the global growth variable as opposed to differentials in growth that is the most important.
Interesting.
So that's just a sort of statistical finding. We can discuss why that is, but statistically and from a trading perspective, that's how it generally plays out.
Right. Okay. So people were expecting a global recession, somewhat mild, somewhat severe, and global growth surprised to the upside for the first quarter of 2023, fourth quarter of 2022. And as such, the dollar weakened.
Yeah, like think about it last year, right? So we kind of had extremely bearish trends up until October last year, right? People got very worried about global growth, very worried about European growth. Credit spreads were widening dramatically since then, right? And then a number of those pressures on growth kind of eased, and we had a release, and the Chinese reopening came on top, right? So that's been very important to markets. Question is how long it's going to last, right? Because that was the story of Q1. Now we're not in Q1 anymore. So getting more tricky now on global growth on this.
Hey there, sorry to interrupt. A lot of forward guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some forward guidance listeners are into crypto. Some own crypto, a smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code guidance10. Thanks, and let's get back to the interview. Yeah, so I know you've got views on where you think the dollar relative to other foreign currencies is headed. Let's set that aside. We'll get into that in a moment. First, I want to know your views on de-dollarization, this narrative that China wants to price its goods in Chinese yuan. Brazil wants to sign a contract where it's going to do stuff in non-US dollar currencies. We see that data, we see those news releases. People make the conclusion that if you just draw the line 5-10 years hence, the dollar will no longer be the global reserve currency. How are you thinking about this, Jens?
Like the first thing I would say is I've been doing macro analysis, currency analysis since 2000. That's when I started doing it at Goldman. And I've been through 3 phases in my career of like talking about the dollar's reserve currency status being really in question, right? So there was a period from 2005 to 2008 when the dollar was weakening very rapidly. Global growth was very strong. There was this focus on, the United States always has a big current account deficit. Eventually, the dollar is going to collapse, and it's starting to happen, right?
Current account deficit is trade deficit.
Yeah, good old stuff. Then we had a period from 2009 to 2013 where we had QE, people call it QE infinity, Fed balance sheet, M0 was expanding, dollar was going down, and it was sort of tied to all this experimental monetary policy in the U.S. is going to undermine the dollar, right? And then that stopped in 2014 when global growth collapsed, China had issues, Fed started to talk about raising rates and so forth, dollar had a big rally. We've actually had a big rally, really big rally from 2014 to 2022, really big. The level of the dollar is very strong. Like if you just think about DXY, right? DXY is 10% above its long-term average now, right? So it's what's very interesting about this period now is that we're talking about de-dollarizations, issues for the dollar, even though the dollar is strong. That I find very interesting. That in a way makes me want to take it more seriously, right? Because if we can have this debate even before the dollar has started to move, think about what the dollar debate can get to if we actually have like a big dollar move down. So it's interesting, right? The other thing that's new is that we have a country, big country, China, that wants to create an alternative to the dollar. And you can go more broadly to the United States in general. And this is very different from the periods in which the euro was regarded as sort of the main competitor, because the eurozone never had a goal of becoming a reserve currency status. In fact, embedded in the sort of euro legal structure is we don't want to have other people pegged to the euro around the world and so forth. So it's different. So China wants to create a reserve currency status, And the other thing that's different is that we have a big war going on in Europe, right? And we have adversaries of the United States that kind of like cooperating. So there's some cooperation between China and Russia. Nobody knows exactly how close it is, but it's there. We have some cooperation between China and Saudi Arabia, maybe China and Russia, maybe Brazil is there sometimes, right? So now we're talking about a lot of big countries that potentially is a big counterforce, right? But just because China would like to create a reserve currency and China has something to back it up in terms of trade, right? China is a bigger trading partner to Brazil than the United States is and has been for a number of years. And that's the same when you can pick many emerging market countries around the world. China is a much more important trading partner, right? So they have something to stand on in relation to trade, right? But that doesn't mean that people want to have the reserve asset, right? So you can see it extremely clearly in the data. Like, it's kind of ironic that China is doing all these things, right? And then we go and look at the data and nobody wants their asset as a reserve asset, right? So this chart here is simply showing how much money is coming into Chinese bonds from abroad, right? And we had a period up until the end of 2021 where maybe every month we got 10 billion. And then things change. Since early 2022, we've had a dramatic outflow from Chinese bonds. Nobody wants them. This is just extraordinary in the context of China's long-term concerted efforts to create a reserve currency. Nobody wants their bonds. And you can zoom in and look at, okay, what's the demand from even the central banks for CNY instruments. And that's the one you have right there. So that's taken directly from the ExAnte data database, right? So these are quarterly flows into CNY from central banks around the world. It can be Brazil, it can be other places, right? And even that has turned negative. Actually, the big flows that you saw early on was when Russia tried to get rid of some of their dollars and euros and bought Chinese bonds instead. But that has also flipped negative over the last couple of quarters, right? So it's a very peculiar situation, right, where despite China's dominance in many trade relations, there is very little appetite from around the world, private sector and official sector, to hold their assets. And this makes it incredibly hard for them to create a traditional reserve currency. And it all comes down to, well, there's many aspects of that, but certainly one important aspect is Chinese currency is not really convertible, right? The capital account is not freely, it's not an open capital account. You can't freely move your capital in and out. And that makes everybody very uncomfortable. And on top of that, obviously, you have a political regime where there's few checks and balances on what the president can do, and that also makes people uncomfortable. So the Chinese currency is not going to become the dominant reserve currency in the world anytime soon. And even though there are lots of efforts to create trading systems anchored around the CNY, there's really no evidence that the CNY is becoming a competitive reserve assets in the sense that people want to own the bonds, own other securities that are denominated in CNY. And that is, at a minimum, going to slow this process that otherwise potentially could have been more of a problem for the dollar. Like, there's lots of aspects to this. Like, China, despite the reopening, right, has not had any rate hikes in this cycle. Like, China has one of the lowest inflation rates in the world, right, because they have excess capacity. They've never had a capacity issue in this crisis. So on a relative basis, Chinese interest rates have gone down, right? So again, that's not necessarily linked to the reserve currency debate, but it certainly makes the currency relatively less attractive. And I have clients around the world, right? So if you speak to anybody who is based in Singapore these days, like they'll definitely tell you that there's a lot of Chinese money coming to Singapore, and that's another part of the story. The domestic capital owners in China are also not that comfortable with just being exposed to China. They actually want to have exposure outside China, right? So that's a sort of a latent capital outflow that China is allowing to some degree, but it's there and has not been fully allowed to realize itself.
Right. So CNY is the Chinese yuan, sometimes referred to renminbi, RMB. Earlier, you referenced the DXY, the US dollar index, which I think is comprised mostly of the euro, a handful of other currencies. Interestingly, I don't believe the Chinese yuan is in that DXY.
No, because it's not convertible. So it's an index of convertible currencies.
Yes, yeah, exactly. And so why do people think that the Chinese yuan will be the next reserve currency if it's not a convertible currency and if they don't have open capital markets where the Chinese, they run a current account surplus, a trade surplus. So who's going to recycle their money into yuan? And yeah, I mean, isn't it a giant problem that no one wants to own their bonds?
So the arguments in favor of China is that China is a very big economy. Depends on how you measure it, right? But some would argue that it's number two, is soon to become number one, just in terms of its size, in terms of trade relationships, way bigger than the United States for many countries. That's the argument, right? But if nobody wants to own their assets, then you have a problem. And this is something that you're seeing around the world. Like we have very kind of like textbook examples of how you create a reserve currency or not create a reserve currency, right? So Russia, for example, at the moment is trading with India and China in local currency, right? And what do they do then? So we've had stories over the last couple of months that Russia is trying to sell CNY, right? Because they need to buy goods in other parts of the world and need the CNY for that purpose. So they don't want to hold them. There's also been a story last week, right, that India has paid for the oil imports they have from Russia in INR, India's currency, right? And the Russian Lavrov was complaining, yeah, actually, we don't want to hold any more of these. We don't need INR. We can't use them for anything, right? So immediately, when there's these attempts to sort of circumvent the traditional dollar-based system, you run into this problem that actually the alternatives, the other local currencies, are not desirable to hold and cannot be used for payments, right? And Russia's actions over the last couple of weeks is an example of that.
Right. Jens, now let's look at some charts you have. One of them talks about, there's this chart of China's holding of U.S. Treasuries, which I think peaked in 2013, 2011, and it just goes down and down. Seems pretty bearish. Seems like as the Chinese economy has continued to grow, its foreign exchange reserves of U.S. Treasuries has dwindled. What's going on? That seems like a pretty bearish story. You've got an excellent chart here. Show us what we're looking at and how this chart that you made at ExAnte data challenges that narrative.
Yeah, so this is just an attempt to be as balanced as possible, right? So when you analyze capital flows, you have to be very, very careful. There's not one truth, right? So when China is buying U.S. assets, they can do it in many different ways. The way the data is constructed is often based on where the securities are held in custody. It happens to be the case that China has increasingly used custodians in Belgium, and because Belgium has big clearing houses, right? So what I'm just showing in this chart is that there's the light blue line is what is typically analyzed in the media, where you say, okay, what is China's holdings of U.S. debt? And when you do that, it looks like, they've gone down from, 1,200 billion in 13, a little bit more than that even, and now we're way below $1 trillion, right? We've lost more than 200 billion in a relatively short space of time. If you take into account that they actually hold some of these bonds in their custodial accounts in Belgium, which is the dark blue line, you can see it's much more stable, right? So obviously, if you want to tell a very exciting story about, the dollar is going to disappear tomorrow, the light blue line is more interesting, but it's probably the dark blue line that's closer to the truth about what China is actually doing. We're not aware of any dramatic selling by China of U.S. securities. We triangulate all kinds of data. We believe the Belgian adjustment is something that's important to do. So this is an example of really looking at the data in a very careful, holistic way might give you a different conclusion.
Yeah, this is really interesting, Jens. You're looking at the individual data. So that light blue line is what people are, passing around on Twitter saying China is dumping treasuries. The dark blue line, it paints a more nuanced picture. It still has declined. It's just a less dramatic decline. So you're adding a layer of nuance.
If you look at the light blue line, you might say, okay, China's sold more than 150 billion of treasuries in the last few years. If you look at the dark blue line, it's like more like 20 or 30, and they might have bought something that is not fixed income, right? So it might net out to zero. So it's a matter of whether they sold a significant amount or really sold something that's totally immaterial. So it makes a difference to me.
It does. And now let's look at this previous chart. What's going on here? The central bank foreign exchange reserve allocations. What's going on here?
Yeah, so this is just another example. Like, we have to be very careful when we look at the data, right? So the best data we have on how global central bank reserves are allocated in different currencies is so-called COFA data from the IMF. You can't get numbers country by country, so there's an aggregate data set that looks at all the central banks that are willing to report to the IMF, and that's now almost everybody. And the blue line there that says 58.4 is the numbers that have been looked at a lot in the last couple of years, right? So we've gone down from mid 60s to 58.4. So people are saying, okay, that's a big decline. So I will just make the observation, right, that in this data set, it looks like the allocation to the yen has gone up. And that's very strange. Why the heck would central banks around the world really want to hold the yen when the yield is the worst of any currency in the world and it's been going down, down, down? Like, is it really such a fantastic currency? And the reason is that people might hold Japanese securities in their portfolio, but they actually often hold them on a hedged basis because of the way the forwards are lining up in the market and what the basis is in the market. You can actually generate a nice yield when you hedge into dollars. And therefore, this data is effectively distorted by that. Essentially, some of the yen in this data are dollars. It's dollars in the portfolio when you take into account the derivatives. The IMF data, and you can call them yourself and check, does not take into account derivatives. It's a data set of the underlying securities, right? And for the yen specifically, the derivatives will change the picture, right? We don't know exactly how many derivatives are on top of that. And we can do a PhD dissertation about what is the right way of estimating that. But it's pretty significant, right? So if we adjust for that, you can get to an estimate of what is the dollar holding within in these reserves, taking into account derivatives. That is a much flatter trajectory than if you don't make that adjustment. So it's just an example. Like, we have to be very careful with this data. Don't trust the headlines, right? You have to know exactly what goes into it. Otherwise, you might reach the wrong conclusion.
So the blue line is the percentage of central bank foreign exchange reserve allocations that are dollars of total allocations. And it looks like it's declining. The yellow line is when you're adjusting it for those swaps. And is it the central banks who have those swap positions on? I wasn't aware that central banks entered swaps for the purpose of making money. I thought they did it for the purpose of, extending dollar swaps to sort of save.
Lots of people are not aware of this. And obviously, lots of central banks will not tell you what they're doing. But there are a number of central banks that actually do tell you, right? And then you say, okay, here's a sample of central banks. We know those guys are doing it. Probably a lot more are doing it in secret. Like, so for example, the Reserve Bank of Australia has had a very big holdings of Japanese securities in the portfolio that are all hedged into dollars, right? So that's an example of how that hedging policy is distorting the data, and they are doing it because they can just get a higher carry that way, and that's the logic behind it.
Right. So you hear of Japanese investors buying U.S. Treasuries and hedging the currency risk, that being a favorable trade. I think about a year ago, April 2022, you saw reports of, Japanese bond investors are pulling back because the hedging costs are so high. Is that the opposite side of the trade? People who are not Japanese are basically taking the opposite side of the bet, saying, hey, I'm being paid to buy Japanese yen and hedge it into dollars instead of being a Japanese investor buying dollars and hedging it back into yen.
Yeah, so those are different sides of those derivative transactions, right? And obviously, from a Japanese investor, like if you just think about a life insurance company, right? So they've had it could be many different types of investors, but the life insurance company that had previously had a significant part of its bond portfolio hedged, where they just roll the hedge like 3-month forward or something like that. Now the 3-month forward has 4%, 5% negative carry in it. That's a lot different from when we had zero interest rates, right? So much harder to hold those. But the bottom line is that if you don't take into account the derivatives and just look at capital flows in securities only, sometimes you can really miss the bigger picture.
That's really interesting. Again, so you're a somewhat skeptical of the de-dollarization narrative. However, it is my understanding that on the level of the dollar, short term, midterm, you are quite bearish. Why is that the case?
Yeah, so it's just a matter of what kind of mechanism you think is in play, right? And it's not that I'm not taking the threat to the dollar from China seriously. Like clearly, you have like another very big economy that's trying to damage the dollar effectively, right? And we have to watch that carefully. But fortunately for the U.S., they don't have such a great alternative to offer, and very few private sector investors actually want it. The other thing we can worry about in connection with the reserve currency status is that U.S. policymakers have this habit of trying to make a big their own goal in terms of like debt ceiling discussions and so forth, right? So if there's a way to really test investors' nerves and ability to trust the dollar, that's certainly a good way to do it, right? So there's not that there's not issues, but I think the bigger issue is whether, like, what is the dollar cycle that we're in, and we have some homegrown banking tensions that might lower what the terminal rate is going to be relative to what was otherwise be the case. So that's a dollar negative that is coming into play. And I would say from a capital flow perspective and an asset allocation perspective, like we have had a just extraordinary cycle, right? Where US risk assets was almost like the sole focus of all investing in the world, like from Tesla stock, tech stocks more broadly, even like meme stocks, like a crazy amount of volume going into those instruments, and almost no focus on other risk assets around the world. I remember I spoke at a conference in October last year, right, where we talked about emerging market assets, and that was like a bunch of family offices, and they came after my speech where I said, okay, there might be an EM opportunity to say, yeah, we haven't invested in EM such a long time, we actually don't know which managers to allocate to anymore. Like, so that just shows you something about we've had like a multi-year focus on only US risk assets, and that I think is coming to an end. We can see it in terms of how the US equity market is trading. Like, look at how the US equity market has traded this year. We've had many weeks of underperformance, not every single week, but like this is not an unusual year. European banks outperforming US banks dramatically. That's also not something that happens so often.
Right, but yeah, and so I think Europe has outperformed America, but what about America versus emerging markets? I mean, I know American stock market has smoked the Chinese stock market, that's for sure, right?
So yes, this Chinese stock market, right, has gone through a massive roller coaster, right? Because we had massive hype around Chinese reopening, especially in January and into February, right? And then that hype kind of ran out of steam. So I think the Chinese story and emerging markets globally is kind of like two separate stories, right? But I think I think we are going through a kind of reassessment about, okay, where should I allocate my risk capital? I'll do another anecdote. So we had a Swedish pension fund that lost more than 2% of its assets, a big one, on just the three banks that went under. So it had viewed those as growth banks, and it was part of the overall growth thesis, right? So lost 2% of its savers' money just on those banks that are out. That kind of tells you something about the skew in allocations when that's possible for a government pension fund. And I think we're going to go through a phase here in the next couple of years where people are going to say, okay, what is my risk budget? Let's make sure I have a diversified risk budget. It's not just one bet in my risk portfolio on U.S. growth. And that's going to be a multi-year process. That could be a real drag on the dollar. It's not something that's going to take the dollar down in one day. It's not directly related to what China is doing in terms of creating an alternative, but it's an important cyclical dynamic after just an incredible run for it, U.S. tech dominance and these types of things. But you also have yield around the world, right? So we have lots of EM assets that have 6, 8, 10, 12% yield. We've not had that since the 90s, right? So the investment landscape is so fundamentally altered compared to what we've been used to really since, some would say 2009, some would say 2014, right? We're in a different world, and that's going to impact things dramatically. Like just make a very, very basic point. We have been in a world where debt was pretty much free, right? We've had economies where we had a kind of levering process happening. More and more debt was accumulated. It was very supportive for asset markets, right? In a way, when you look at what's going on now, where we have interest rates coming up from zero to significant levels, it is actually the economies that have a lot of debt that are facing challenges. That includes China. It includes United Kingdom, includes the U.S. to some degree. And then you have some emerging market economies that don't have a lot of debt. Doesn't make a big difference for the economy whether interest rates are 4%, 8%. Our economy operates roughly the same, right? So inflation changes everything. And what are the winning assets, losing assets? Clearly going to be a different environment where we have very significant interest rates as opposed to zero interest rates.
What about growth? If the U.S. is entering a recession, kind of becoming a mainstream view, curious your thoughts on it. If the U.S. is entering to a recession, growth globally will be not so good. Chinese reopening, who knows? That typically is a good environment for the U.S. dollar, where the U.S. dollar appreciates against other foreign currencies. Why do you think that will not be the case this time?
Well, so we have global growth views that evolve all the time. We track an insane amount of data with all kinds of alternative data on global growth, right, to see if we can have an edge in that. So it's possible I'm going to change my view on global growth next week based on all the data we track, right? So what our view has been recently was that the Chinese reopening process was running out of steam. Our alternative data tracking in China, which I believe has been very reliable and through this phase, showed that momentum kind of peaked out in the third week of March, and it's been gone down. It's complemented not just by Chinese alternative data, also all the trade indicators with all the countries that trade with China. They have a similar pattern. So there's some weakness there, and that's been playing into actually Asian currencies for a period of time, Asian assets, right? But whether that's sort of a more tactical setback from sentiment being too elevated, or whether that's a trend that's going to continue on a multi-month basis, we're going to let the data speak, and we will reassess that as we get it. And I have some concerns. I have some medium-term concerns, right? But typically markets are very nonlinear, right? So it's not going to be just one trend like that.
Right, definitely. But in the U.S., we have a very inverted yield curve. Bank lending, we haven't seen it contract that much in the hard data, but you yourself said you expect it to contract. I mean, do you think the U.S. is going to enter a recession, mild recession? And historically, recessions are one where the dollar is strong.
So in terms of the recession outlook, right? So there's nothing in the data right now that suggests that the recession is just around the corner. Can't see it. You can have some projections around what's going to happen in a couple of quarters. Excess savings run around. Maybe there's going to be a big fiscal drag. Depends a little bit on what happens around debt ceiling negotiations and so forth. So I would say my view there is that it would be strange if the U.S. doesn't face a significant slowdown, recession, but the timing of that is crucial. Is it going to be in 1 quarter, 2 quarters, 4 quarters, right? And I would say it's probably a little bit further out. That's another reason why the Fed should probably just be on hold for a while. The relationship to the dollar, now it's getting interesting, right? So you're absolutely right? That historically, not forever, but in the last 20 years, we've had a strong link between growth assets, S&P, and the dollar, and i.e. S&P down has generally supported the dollar. So one of the most important things to think about right now, if you have an international portfolio and from a risk management perspective, is whether that correlation has potential to break. Last week was very interesting. Last week we had U.S. equity underperformance and the dollar was down. So there's something about the regime we're in where if it is the case that the U.S. equity market weakness has to do with U.S. valuations being high, with the shock being homegrown, with all kinds of global investors being overexposed to U.S. equities, then the down move in U.S. equities don't have to support the dollar in the same way as the historical statistics have shown, right? So again, when you analyze data, including historical correlations, right, you have to have some kind of view as to what is the structural link in the economy that generated that correlation and does it hold up? And this is a tough call, but I think there's a chance that correlation is in the process of breaking.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. Yeah, and a lot of the charts that we put up on screen so far are from ExAnte, your shop for institutional investors mostly. But it's my understanding you've got a new product called MarketReader. What is MarketReader? Tell us about this new venture. And maybe we can start by what you thought was missing in sort of the traditional financial news flow that people get.
Yeah, so I've been advising institutional investors for more than 20 years, right? When I was at Goldman, when I was at Nomura Security, Bridgewater, and so forth, and also with ExAnte Data in my own company, where we have like top macro funds and other asset managers as clients. So I thought it'd be really rewarding, exciting to do a piece of software that everybody can use. So the philosophy behind MarketReader is that we want to instantly explain market moves, right? So if there's a gap in a stock or another asset, we want to say, okay, why could that be? And we go through all the dimensions that a top trading desk at a hedge fund or an asset manager will go through to understand what's going on with their portfolio. It can be many different things, right? Most simple type of driver of the market is a piece of news that come out, like bad earnings from a company. But it could also be somebody needs to do a block trade. So it's a flow. Or it could be that, Delta Airlines is picking up weak consumer demand, and that moves United Airlines. So cross-asset correlations are a huge part of what's going on. So we go through all those different dimensions, and we have them programmed out, and we have the robot, or whatever you want to call it, watch all assets simultaneously. And it's the simultaneous analysis of all assets that the human cannot do, adds a totally different dimension. And I think it's like we've used this tool already in a way that I didn't expect. Right. So when the Silicon Valley Bank news started to come out Wednesday, that catastrophic week, like we got alerted from MarketReader that there's something odd going on in the aftermarket. And we started to look at what's going on. We could see it was spreading to other stocks, right? And like First Republic was back down already back then. So it was a fantastic early warning signal for what was going on with the banking crisis. And it's really because we can just watch so many things. Like at the moment, we have 11,000 assets in the system. We can watch big assets, small assets. We do a lot of analysis where we look at like volatility adjusted moves, right? So we know what is a normal move for every asset, and we really focus on the stuff that is unusual. And I think it gives new insights. It also gives time to look at more stuff. And then we apply AI. It's almost like we apply AI to simplify things. Once all our models have run and given their conclusions about what's going on in the market, we can tell a ChatGPT or whatever other AI infrastructure is the optimal to say, okay, why don't you summarize it for me in 20 words? And when you have all those summaries and can look at so many assets in such a succinct way, you can just save an incredible amount of time. So that's what we're building. So we have not launched yet, but within the next couple of weeks we will launch. And we hope to help a lot of people. So this is not just for institutions. This is something we believe a huge amount of people can take advantage of. And that really should be a new way to read the market, a new way to absorb financial information.
Super interesting. Yeah. So walk us through Delta Airlines falls 15%. There's a news article written about it, and it says something like Delta stock falls 15% amid concerns about blah, 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 or as something, blah, 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 blah. The as or amid is a sort of journalistic way of hedging your bets, of saying, I'm connecting these two events, but I'm not saying that A is happening because of B. I'm saying A occurred amid B, or as B is being developed. How, even with the power of very smart and advanced quantitative methods that you develop, as in addition to artificial intelligence, how is it possible to know why something fell? Isn't it really impossible to say, to sort of connect the dots?
It's impossible to know with 100% confidence, but it's possible to know with a very high level of conviction, right? So in our system, we don't necessarily show this to the user in the first glimpse, but underlying the output, we have something that we call a causation confidence metric. So we have some fairly elaborate math, right, that generates a causation confidence metric, right? So in the example you're outlining, right, you have a situation where United Airlines is moving, but really the cause of the move is that Delta Airlines said something about demand, which is clearly going to be relevant for the overall industry, right? So in that situation, we have a whole set of metrics that we look at, and our causation confidence might be, 85%. So we will flag that to the user. United Airlines is moving. It's likely due to the fact that Delta Airlines has said this and that. And that is what we call super news, right? Because it's a different type of news. It looks at potential drivers in a much more broad sense than just, company specific news. And if you think about all the gaps in the market and so forth, I think, our statistical analysis suggests that you can only really explain 10 to 15% by, instrument specific news. If you look at the cross asset links, news by association, you capture an immense amount more. maybe 70%. Then the volume gets you to 80 and so forth. So with a whole list of potential explanations, you can really fill the gap in your understanding of the market in a way where traditional tools doesn't allow you to do that.
All right, so let's say there's a human being who on Wednesday, March 8th, Silicon Valley Bank announced that it had sold essentially all of its available for sale securities, and it was going to raise new equity. It was your former employer, Goldman Sachs, was the advisor, and maybe there were some tactical mistakes there. Things could have been done better. That news item, I remember seeing it. I remember the stock being down a lot. How would the machine know, or how would it have a percentage of confidence that more trouble was to come? Because frequently, you have Snapchat earnings are a huge disaster. The stock's down 40%, but then everything's fine. How do you know that things are going to go systemic? What were you seeing that Wednesday night that the human being was not?
So I think so. First thing I would say is that MarketReader is set up to, in real time, digest everything that's going on and explain what's happening. It's not going to give you a forecast of what's going to happen in 2030, right? So it's not like predicting everything into the future. So it's mostly about absorbing what's going on extremely efficiently and very objectively. But I would say on that day, and the way I used it, and I was actually tweeting at the time, so you can go and see what's on the J Nordvig Twitter feed.
I was watching.
And so I think what was very interesting there was that we could watch all the different instruments in real time, right? And we could immediately detect that, okay, First Republic is being hit by this. Lots of people who manage a lot of money have never traded Silicon Valley Bank. They've never traded First Republic Bank. Those are not instruments that are on the screens, right? So being alerted to those smaller names that is actually driving the big names on the day is really important. So I would say the most helpful aspect of this was to get the early warning on Silicon Valley Bank, and then the whole list of contagion effects. And the system did tell you, right, that it is contagion from Silicon Valley Bank that is driving these other stocks. And that was a really, really helpful heads up, and something that really gave you almost 24 hours on that instance before, Bank of America gapped in the afternoon the day after.
Right. Yeah, that's interesting. What is MarketReader saying or indicating or showing about regional bank stocks right now? By the way, we're recording the afternoon of Tuesday, May 9th.
So I would say the main message over the last couple of days have been that when I go and look at each stock in the sector, and we use smart screeners to do that, and you can go into like the MarketReader handle is at MarketReader Inc. We've sent out a number of those screenshots where we scan the whole banking sector and get these short summaries. But the main message over the last couple of days really has been that the whole sector is moving in tandem. So the whole sector is moving in these cycles, and we will go in and analyze, okay, is this stock moving for any company-specific reasons, macro reasons, or sector reasons? And it's really been a sector dimension that has been driving the ups and downs. We've not had any single names in the last few days that have had enormous moves, but the whole sector kind of moves in these 2-3% cycles during the day. So that tells you a lot about short covering playing a role. We've also had very, very high volume detected in the system, right? So now we're sort of in a behavioral finance type regime where a lot of that is driving the price action as opposed to any given single stock announcement.
And how do you model that? Silicon Valley Bank fell, the news itself was not fatal on that Wednesday, March 8th of they have to raise new equity. The reason it became fatal was because the stock sold off. All of these venture capitalists who are on Twitter and tweeting a lot, they noticed the stock fell off. They withdrew deposits. The withdrawn deposits caused a news release from Silicon Valley. The stock goes down more. Suddenly by Friday, it took less than 2 days for the entire house of cards to collapse. Suddenly you have a new Federal Reserve facility, 4 days later on Sunday. How do you model that? Is it possible to be modeled where a fall in the actual share price can cause a decrease in the fundamentals? And what I've been saying is, if the stock of Coca-Cola fell, it's not like people would stop buying Coca-Cola. But if Silicon Valley Bank fails, people do withdraw deposits.
Yeah. So again, I would say the goal of MarketReader is not not to use artificial intelligence and tell you what to go and put in your portfolio next year or something like that. The goal of MarketReader is to allow you to absorb an incredible amount of information for a large set of securities, zoom in on the securities that you are interested in, and give you the conclusion about those. And I think in this specific example, it was extremely helpful in terms of highlighting the issues early, highlighting the contagion early. Like, for example, like that evening, right, where you were highlighting what's happening, like we picked up all those different steps, like the initial announcement of sales of the securities, like the different VC announcements on Twitter that caused the run, right? So we could track those step by step. But in the end, the goal of this tool is to assist the human. It's not set up to make a trading rule and trade your portfolio without you looking at it. It's meant to give you fantastic information, better than the information you can get currently, and that's going to empower you to make good risk management decisions.
I like that. I gotta check MarketReader out. Jens, before I ask my final question, so you said the Twitter account is at MarketReader Inc. Where can people find out more? What's the website?
So it's marketreader.com. So what I would encourage people to do is we have essentially an early access community where you can sign up. And then in a few weeks, we'll open it up for those who are on that list. And we're hoping to really get a dialogue with that early access community so they can say, this is a fantastic tool, but I really would like that. And we have an extremely nimble team, right? And then we're going to try to add those features that are most in demand so that we can have a nice symbiotic relationship with our early adopters. So if you go to marketreader.com, please sign up. We would love to have engagement with you and learn from what you think will be the most useful next feature that we haven't programmed yet.
There we go. Thank you, Jens. My final question for you is, what is a macro view you have about a certain asset that we have not discussed yet, which you feel like is worth noticing?
We talked a little bit about a really important one, right? If the dollar's correlation to risk assets, like you can just think about it as the S&P, if the dollar starts to go down when the S&P is going down, then you really need to sit up in the chair. I'm going to do it myself, sit up in the chair. That's something that you want to pay attention to. If that's the case, right, then you need to think about risk management for your portfolio differently. So that would be sort of the one takeaway that I would stress once again.
There we go. Jens, thanks so much. People can find your work at J Nordvig. Thanks again. And thank you everyone for watching.
Thank you very much.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again and be well.